How do we analyze companies? The first section here, we're going to talk about liquidity and efficiency. Now, one of the things that I think we need to look at first is what kind of data do we actually look at, or are we going to find in a company? I suggest you download financial statements. There are several sources of it. I think the most reliable source are annual reports and the 10Ks from the SEC. But you can also get financial statements from Zacks.com, from Yahoo Finance. And I think for the most part they are reliable. However, I think they compress the statements a little too much, and we may miss some information that we need to make a better financial summary, if you will, of the performance of the company. In addition, you would like to have some information about what managers think. So you have the, as we talk about here, there are other statements, other pieces of the annual report that might be important. So let's start with the balance sheet. Looking at financial statements from an analysis or an assessment of performance is different from the accounting process. Right? The accounting process creates the statements. We now have to interpret the statements. So some of this is rather simplistic, but I think it really touches on or emphasizes the information that we want to not only analyze, but that we want to provide to whoever our stakeholders are, whoever wants the information. So let's look at the balance sheet. We need to understand what assets are. Assets is what the company owns. It's the things that they've purchased. The management team has purchased this asset base to operate the company. We want to determine how well are they managing those assets, and have they been good stewards in the purchase of assets? So that is, are they providing the company with the types of assets that are productive and efficient? Liabilities, obviously, it's what the company owes. You know, where did they get the money to buy the assets? This obviously includes stockholder equity. But stockholder equity as a formula for the accounting formula is just the difference between the value of the firm's assets and its liabilities. So the right-hand side of the balance sheet, which is liabilities and equity, basically describe where the money came from to buy the assets that the company is using in operations. So we need to kind of keep that in mind. Where does the company create value for its shareholders? It creates value by making things, providing services. That is all done on the left-hand side of the balance sheet. The right-hand side, quite simply, just says, where did we get money? It's a different type of an analysis, as you'll see when we go through these videos on financial analysis. So here's a very simple picture of a spreadsheet that I've created that basically breaks things down. What you can see typically are the yellow boxes are boxes where data entry is made. The blue boxes are boxes that are formulas. So I have compressed some of the data so that we really only analyze or have line items that we're going to utilize in the formulas for financial analysis. This is a fairly standard type of balance sheet. For this particular company, one thing that's a little bit bizarre maybe is if you look at the common stock account, with the exception of 2013 here, they are all negative. How can common stock be negative? Well, it is simply just a calculation. It is the total liabilities and equity minus the total debt and retained earnings. So what's left here are the common stock accounts and the treasury stock accounts. Many companies have fairly large holdings in treasury stock. So this line item turns out to be negative. On the plus side, we don't use common stock in any formula. What's used typically is total equity or liability and equity, the sum. But we don't use this particular line item. So again, just want to kind of point out some of the bizarre natures of this particular company. Income statement obviously shows where the expenses are for the company. I really like to think of these profit items, right? I mean, when you get to the bottom line here, I mean, that's where the emphasis is. But quite frankly, when you're analyzing performance, net income is it's not the highest priority of measuring performance. We want to understand how the company is producing its product. How efficient are they at doing that? We want to look at how efficiently they are running the entire company through its operating income and margins. We want to understand the impact of their leverage choices. So net income, the bottom line, is really of lesser importance, if you will, if you want to talk about analyzing management. So here we have the again, the income statement for this particular company. Again, what I want to emphasize here is something a little bizarre that you may find. Number one is when companies produce their annual statements, they don't always use negative signs. Sometimes they'll put them in parentheses, sometimes not. But in general, we have to input the negative sign so that you can see the summation in the formulas as we go through this. So it's a little bit different, if you will. And again, some of these blue boxes don't make necessarily any sense. We have to just kind of understand that they are summaries of blocks of information, and that line item typically is not used in a financial statement. So the other thing that I think is important to understand is that there are really two kinds of financial statements. There are financial statements for manufacturing companies, retail companies. Those particular kinds of companies have costs of goods sold. There are also the other side of the coin, which are service companies. Service companies do not have a cost of goods sold item. As you can see here, this line item, they're all zeros because this particular company does not sell anything. They provide services. So when we go to look at some of our profitability ratios, we're going to have to take that into account, that there might be some ratios that don't work with respect to this company because cost of goods sold is not a line item. The statement of cash flows is very important. There are essentially three sections that describe management's activities throughout the whole year. Operating activity, what type of cash is created running the company? It's this line item right here, cash flow from operating activities. You can see in this particular company in 2015, they actually lost cash from running the company. That is extremely important. That is a terrible thing. In 2014, it was negligible. It was very little amount. So this company apparently is in trouble. Investment activity. How did they make money from investing in things? Well, cash from investing. They actually spent money by investing in plant and equipment. So in general, that's good. They're trying to grow the company. But they're growing the company while they're losing money running the company. possibly a challenge. But in the end, if you look, they actually have an increase in cash this year. How did they get an increase in cash? The only way they were able to increase cash was by borrowing money. So they borrowed a substantial amount of cash to keep this company afloat this year. If you note, the year before, they actually had a negative change in cash for the company. Again, this is part of the analysis process, trying to determine how management is making the company grow. This is kind of insightful, I think, with this particular company on this spreadsheet. Again, for our analysis, we really just picked out some of the most important data from that statement. Here are the 3 cash flow items, but for ratios and analysis, we also needed a depreciation and amortization number available from that statement, and also the amount of dividends that were paid from that statement. So again, those are the line items, the particular things that we need to form financial ratio analysis. The analysis and our summary of that is helpful, or is assisted, if you will, from some other information in the annual reports. This is the management discussion and analysis page. It's also the notes of the financial statements describe how things are created, or how the accounting was actually done. In particular, one place that this might be helpful is with interest. Frequently, companies will identify or calculate net interest. So if it's net interest, we need to know what the interest expense is and the interest income. We need interest expense because that is an important line item for determining whether or not the company can actually pay on their debts, the interest portion of their debts. So we want to analyze that. So we have to pull that. When you read the item, if that's what you see, net interest, then you have to go to the notes to figure out the composition of those numbers. And they give them. I mean, obviously they have to give them. It's part of the process of reporting. So with that in mind, let's move to the first set of ratios that we want to talk about. In this case, we're going to talk about liquidity and efficiency. Liquidity refers to the ease with which you can convert assets to cash. Now, in this case, what we want to talk about is a little bit differently than this basic definition. We want to determine if a company can pay its bills. So from a financial ratio analysis perspective, the definition of liquidity is, can the company pay its short-term obligations? What is their ability to pay them? So liquid assets frequently have lower rates of return than fixed assets. So if a company is very liquid, that is just as bad, well, not just as bad, but that is troubling, just like not being able to pay their bills on a regular basis is. So let's kind of move to the ratios. And in my analysis, I use a variety of, a combination, if you will, of industry numbers and company numbers. The company numbers all come from the annual reports. The industry numbers come from a publication. It's RMA. It's the Risk Management Associates Statement of Annual Studies. What this does is provides, in a very concise form, the average ratios for a particular industry. And how we identify the industry is by its NAICS number. So for this particular company, that's where the industry data comes from. There are 3 basic ratios. They all measure liquidity, but they all have varying levels of conservatism, if you will. The current ratio, current assets divided by current liabilities, is the least restrictive. It gives us a picture of their ability to pay in total their debts that are on the balance sheet. We would like this number to be 2 or more, but quite frankly, we always want to, as we go through this analysis, you always want to compare it to what the industry is doing. We are gathering industry median numbers. It's the dead center in the middle. So of course, we would like to perform better than the average. If we wanted to be very restrictive on our assumptions or our analysis, we might say we want to be better than the upper quartile. We could do that because RMA gives us, for most ratios, gives us numbers that are segmented by quartiles. So these industry numbers reflect the median. The quick ratio is more conservative. It's more conservative in that it subtracts inventory from current assets. Inventory is the hardest asset to convert to cash. So when we subtract that out, we get a much more conservative picture. The cash ratio is the most conservative. Basically, the cash ratio says, look, how much cash do you have right now to pay all the bills that you currently owe on the balance sheet? So it's very conservative and very restrictive. So let's look at a picture. This, as this sets out, this is a picture of this is a picture of the current ratio for the company and the current ratio for the industry. Here's the quick ratio. Here's the quick ratio for the industry. And then here, obviously, this light blue is the cash ratio. So when we look at this, we want to compare the blue and red. Here's the blue, dark blue. Here's the red. We can see that in general, we can make some statements. This company currently has less liquidity in total than the industry does. So when we look across this company, you can see that the number is very close to 1. It's never less than 1, but it's very close to 1. So if that's what our history is, we maybe want to take a little closer look. Now, as you can see, it's really not dramatically lower, but it certainly is less. Let's look at the quick ratio. When you look at the quick ratio, you can find out that there is some differences here. Now, I happen to know that this particular company has very little inventory. So there shouldn't be that much difference if you look there between the numbers. But if we look at the picture, here's the green is the company, right? Here's green. And there's a couple of years, but we're very close to the industry. So what we might say in general about liquidity is that we are very close to the industry. We seem to be fairly stable. There's no dramatic increases or decreases over time. And of course, the number is a little low. So in general, we would like the liquidity to be a little bit higher, but it doesn't seem to be dangerously low or dangerously different than the industry is. In general, we can see what we find for most companies, that is with respect to the amount of cash they have readily available, right? I mean, it's not a tremendous amount. You will rarely see a company have enough cash to pay all of their bills if they wanted to. So we basically have a picture now of the company's liquidity. What about efficiency? How does the company work towards providing profits, right? How do they manage, or how well do they manage the assets of the company? So the next thing we have are some ratios. The inventory turnover ratio and the asset accounts receivable turnover ratio. These are certainly very useful ratios. I find them difficult to explain and difficult to utilize overall in measuring the overall growth or the efficiency of a company. I prefer to use what I refer to as the days numbers. DCI, how many days on average does the company carry inventory? How many days on average does the company have accounts payable or accounts receivable outstanding? In other words, how quickly do our customers pay us for the products that they buy that they have purchased on credit? And then finally, DPO is the opposite picture. How long does it take for us to pay when we buy assets on credit? So here's days carry inventory. If you look at the two companies, this particular is a different slide, because if you remember, the company that I showed you in the beginning does not have cost of goods sold, and that's part of this day's carry inventory. So I just want to let you know, this is not a slide for this particular company. It's another company, this TAP company. As you can see here, the industry, in this case, the industry has a higher days carry inventory than the company does. Essentially, what this says is that the company has less inventory. It buys inventory, converts it to product, and sells it quicker than the industry does on average. So what could this possibly mean for the company? Well, they have less storage space. They may have less insurance to pay for insuring that whatever inventories they may have. So it could possibly mean reduction in costs for the company. On the other hand, it could also mean that the company is maintaining a low amount of inventory because they don't have enough cash to buy inventory, which could affect production or sales, etc. So again, there's lots of things we could talk about with respect to days carry inventory and how the company is performing. Likewise, here's the picture of the company that we actually talk about. This is the company with those statements. We see that we just don't have an inventory, a cost of goods sold number to talk about with respect to this ratio. Days sales outstanding, though, is important. People buy money from us or buy things from us on credit, and we wait for them to pay. This is the number of days. And you can see that this company has a much higher days sales outstanding number than the industry. And obviously we want it to be closer to the industry. We want it to be below the industry if even possible. But really, if you look at the number, on average, it is roughly taking, on average, around 60 days for people to pay us for our accounts receivable. Is that good or bad? Well, if the company is profitable and if the company has cash to maintain its business, that's fine. But they need this cash. Why should these customers owe us money for so long? Accounts receivable are interest-free, right? They don't pay interest on accounts receivable. So this is a problem. Again, one thing to keep in mind, this definition, right? It is the average amount. So what this tells us, we actually have customers who are not paying us longer than, for a greater period than 60 days. Maybe it's 70 or 80 days. We really want to pay attention to this because we need that cash to maintain our business. Days pays outstanding. I think this is kind of reflective here, right? If in this particular case, this company, right, they typically don't pay their bills on time. And if you look at it, it's a relatively longer period of time than the industry. In this case, over 2 times. It's taken them 2 times longer to pay their debts than what the industry does. Is this good or bad? Obviously, it's bad, right? This could affect our credit rating. This could affect the way our potential suppliers look at us. If they see we don't pay in 50 days, they may not want to sell us things. They may not want to use us as their client. Fixed asset turnover ratio and the total asset turnover ratio. let's change our picture from short-term assets and now look at long-term assets. How well is the company using the assets of the company to create sales? A higher number is obviously better than a lower number, but let's look at the data. What do the financial statements tell us? Well, we see some very telling information here. It's a little difficult to see here, but here's the fixed asset turnover ratio of the company is the blue. It's right underneath here. It's a fairly low number. Compare that to the fixed asset turnover of the industry. It is a much higher number. So the industry is more efficient in using its fixed assets than we are by a far margin. What about the total asset turnover ratio? Again, as you can see, the industry is far better than we are, right? We're green, the industry is the purple. So we would look at this company and say, we really need to look at the assets that we have. What are we doing with those assets? Do we really need those assets? Maybe we need to figure, well, there's really only one of two things we can do. And I'm going to backtrack a slide just for a second. We need to figure out how to increase sales. Everybody wants more sales. It would be nice if we can increase sales. But we need to look at our asset base. Are we being good stewards with our investors' money? Have we purchased the right assets to get the job done? Do we have assets that we do not need? We must look at this and reflect carefully on that. Potentially, maybe we have divisions that we could sell that we don't need or that are less productive. So let's look at our total investment in our asset base and try to figure out what to do to use our assets and, quite frankly, just be better stewards of management of those assets. A final kind of analysis that we can do is something called a cash conversion cycle. Now, looking at the cash conversion cycle basically takes our days ratios and puts them into perspective with the business cycle itself. The operating cycle is a time period from how long we have inventory on average to how long we get paid from the sale of those assets. So this operating cycle, quite frankly, I think is the most important number here, but is reflective of the process of buying the inventory to selling the inventory and getting paid for it. That is a very important time period. We can look a little further and then adjust that number for how long it takes for us to pay our bills. We would like this cash conversion cycle to be as close to zero as we possibly could get it. We would like to coordinate the production of assets and the receipt of money from those assets to the sale, or to the payment for the borrowing of that inventory. So we want this to be as close to zero as possible. Again, this is another slide. If you look at the slide, we have a cash conversion cycle that is greater than the industry on average. And in fact, it's substantially different every year. Now, what happened in 2012? For this particular company, in 2012, something very bad may have happened to the company because they, on average, in 2012, it took them 191 days on average to pay for their inventory. Now, from a cash conversion cycle perspective, this is great because not only is it zero, it is less than zero. But from a credit perspective, we may have damaged our credit with some of our suppliers because we're taking way too long to make payment on our assets. So again, that is how we analyze the assets that are, quite frankly, maybe the most important to us. We're looking at liquidity and we were looking at efficiency.